Hi, I'm Jimmy. In this video, we're looking at how to value energy stocks. So we're talking upstream, midstream, and downstream oil and gas companies that pull the oil out of the ground, ship it or store it, and then those that refine it or sell it at gas stations, companies like that. But also utility stocks. I'm talking companies like Con Edison that, sell electricity to households, things along those lines. And then towards the end of this video, we're going to go through some companies that look like energy stocks that look like they could be undervalued today and worth doing more research on. So let me know in the comments below, which companies do you think we should do some research on? Now, before we get into that, I just want to tell you real quick about a website that we're building. It's called investorsgrow.com. And basically, it's a place that we've developed to try to make it quicker and easier for people to value stocks and ultimately do their entire analysis. We also have 3 private investing live streams that we go through each week. If you'd like to get access to that, I will give you a link in the description below. It's called investorsgrow.com. And those live streams are a lot of fun if you want to join us. We talk about the economy. We talk about building portfolios. We talk about analyzing companies, doing research, things like that. If you're interested in that type of thing, link in the description below. Okay, now let's jump into the first valuation method for analyzing energy companies. And that is generally one of my favorites, discounted cash flow. Now, specifically for discounted cash flow, this works for many of the larger oil and gas companies, not utilities, oil and gas companies specifically, that generate a reasonable amount of free cash flow. The way you can determine it is free cash flow and revenue, or free cash flow and earnings per share, relatively predictable? If if one year they have a ton of free cash flow, the next year they got no free cash flow, well, that probably won't work nearly as well. Now, just so we're all on the same page, the way discounted free cash flow works is first we have to make assumptions about how much free cash flow we're going to generate or the company is going to generate each year. So let's say we were to come up with whatever the company is, and we first thing is come up with what our estimates are for each year for free cash flow. So maybe you're going out 3 years. Now, to make this simpler, on the Investors Grow website, we actually have analyst estimates for, it's thousands of companies worldwide where analysts submit what their free cash flow estimates are. We tell you how many analysts do it, so the more analysts, the better. But then basically what happens for discounted free cash flow is we project what free cash flow is going to be each year, and then we discount that back to today. That's the entire concept, with the point being that a company today should be worth the present value of all its future cash flows. Then ultimately the result will shake out to be something like this. And we can see here with whatever this company is, this is an irrelevant example. I'm just showing you how it works so we know what we're looking at. Well, basically we could see that the price is a bit under $115 a share. The fair value is slightly under $150 per share. So what we're looking at when we're looking at the chart is pretty much anything on the left side of the chart. If the arrow is pointing over there, it's undervalued. The more it's pointing, the more undervalued it is. Ideally, we want to pay attention to the margin of safety. Right now, the margin of safety is about 24%. That's how far the fair value is away from the current price. So depending on our research, what we should do is we do our own research on the company, and then we say, okay, I want for this company, maybe it's a smaller company, we want a bit bigger margin of safety. Maybe you say, all right, I want a 25% margin of safety. Well, in this example, the company would almost be there. Maybe if it's a bigger company, you're less worried about less risks. Maybe you include a smaller margin of safety, maybe 10, 5, 20, something like that. Well, that's basically what we're looking at when we're coming up with, when we look at discounted cash flow, when I show you different charts. If it's on the left, it's good. If it's on the right, it's not as good. The further right, the more of a value. Okay, the next valuation method that could also be good is something called enterprise value to EBITDA. So on the website, what we have is a chart like this. Now, this is a chart that gives us different averages. So we've got the 5-year average, the 10-year average, and the 20-year average for whatever company we're analyzing, assuming they've been trading for long enough to give us this data. With the idea being that the first thing we want is we want the range to be relatively small. Now, there might be some exceptions to that. I'll show you an example in a little bit when we look at some actual companies, but we want the range to be relatively small. So here we can see that on the low end, this thing's trading around 4, 5x. On the high end, 13, 14x. That's a relatively tight range over a 20-year period. And we can see the time period down here. So clearly it's been a while. But the idea is, wouldn't we rather buy this stock, down at this level? Well, without being able to analyze the history, it doesn't make a ton of sense. So here we can look at this, and if this is a company we're interested in, well, we can say we know where we want to buy it. Now, in this case, this company is a bit overvalued. You can tell that because the pinkish line here is slightly above it. That's not a good thing. Okay, now the final valuation method that's good for energy stocks is the very popular price to earnings multiple. So this works for large oil and gas companies. Well, maybe not just large, but as long as they're profitable. Clearly, you need earnings for earnings per share to work. If a company is smaller and perhaps not profitable, use the enterprise value to EBITDA number that we just showed. That's the number if a company is not profitable. That one should work because most companies are going to have positive EBITDA. Okay, so this is the one that also works for utilities specifically. And regulated utilities universally, when I reached out to analysts that covered regulated utilities, again, companies like Con Edison, any company that you might buy electricity from as a household, especially in the US, well, discounted cash flow doesn't work for them because they're so heavily regulated. Their free cash flow can be super volatile, but earnings per share tends to be fairly reliable. Almost universally, analysts use price to earnings multiples. So basically, what we would be looking for is the same type of thing we saw with enterprise value to EBITDA. We wouldn't want, here's an example. The S&P 500, the average price to earnings multiple for the S&P 500 is about 20x. Well, my question is, 20x is up here. If this was the company we're analyzing, whatever company it is, would we want to pay 20x? Of course not. If we paid 20x, we way overpaid for this thing. In fact, we'd be losing money today if we had paid, we'd be losing a little bit because the stock has come up since, it was last at 20x. But wouldn't you much rather buy it down here around 5x? To me, that is by far the more logical thing to do. But 5x sounds like it's a screaming sale. But we know when we've analyzed the history that 5x is actually a logical place to buy it. Okay, now let's jump in and look at some energy stocks and utility stocks that could be undervalued today and could be worth researching a bit further. So our first one is called Sempra. Now, this is actually a diversified utility, but price to earnings works fairly well with it. Now, the first thing I want to point out, and I alluded to this earlier in the video, where I said generally you want there to be a tight range, but sometimes, at some point, this is a chart that goes back the past 10 years, but we can see that there are some random spikes here that earnings got really, really low in a particular quarter. This is a quarterly chart, so each dot represents a different quarter. Well, the tough part about this is when you're looking at it, it's not terribly usable, right? This data is not, how is it undervalued or overvalued? If you don't look at the table here, it's really tough to tell. Well, we set up the website so you can actually click on the individual data points and it will remove it from the chart. Now, it does not remove those data points from the averages. By the way, the averages are all calculated taking the median number, so the middle number over the past, let's say, decade. And when you click on that, then we end up with a chart that looks more like this. And clearly, this chart's a bit easier to see that, well, this stock is undervalued when you look at both the 5 and the 10-year averages, but slightly overvalued when you look at the 20-year average. So, depending on what our research tells us, clearly, if this stock gets down to, let's say, 12, 13, 14x, this thing could be a screaming sale. But even right now, it could be a bit undervalued and worth at least researching and putting in our bullpen. Okay, now let's jump in and look at an oil and gas company. So this is a company called EOG Resources. And what they do, they call exploration and production. That basically means they pull oil and gas out of the ground and sell it. Now, we can see using discounted free cash flow that right now, the fair value for this stock is at about $133 a share, and the current price is about $125 per share. That gives us a margin of safety about 7%. Now, that's a bit low for me on a margin of safety perspective, but depending on what our research tells us, this could be an interesting one to at least add to the bullpen. Now, a lot of times I like to click over on multiples here and check out what other valuation methods might look like for this particular stock. And here we can see that when we look at price to earnings, well, it looks like it could be undervalued a reasonable amount. In fact, as we can see in this table, the 10 and 20-year averages has this stock valued at about $200 per share. We'll combine that with what we're getting with discounted cash flow, and maybe there is a greater opportunity in this stock than we might have previously considered. And what about enterprise value to EBITDA? And you know what? We'll zoom in a little bit here to look at this one. But here we can see with enterprise value to EBITDA, we could see that using the 10 and 20-year averages, the stock does look like it is in fact undervalued. Using the 5-year average, a bit overvalued. Again, all good information to have. Now, another thing we might consider when looking at an oil and gas company, because of the nature of the oil and gas industry, they tend to be a bit volatile, but a lot of them pay decent dividends. Well, this one is paying about a 4% dividend, almost $5 per year over the past 12 months. They paid about $4.97 per share. This is a chart of their dividend history. Again, not quite as stable as we want, but there's some random spikes in there. But overall, their dividend is fairly reliable. So this could be an interesting one to go ahead and do some research on. Okay, now let's jump into our next company. And this is a downstream company. Downstream is when they do refining, they have gas stations, things like that. It's all considered downstream. If they do refining, basically they turn oil and gas into gasoline, jet fuel, things like that. Or if they have gas stations and they're actually selling the gas to retail customers, wholesale customers, things like that. That's all downstream. Valero is a downstream company. And we can see that using discounted free cash flow, which for me, many times is my favorite valuation method. Well, we can see that the fair value is at about $230 per share, while the stock's trading slightly over $150 per share. So Valero looks like an interesting one. And then when we jump over to verify this with price to earnings multiples, well, we can see that the most recent PE multiple is on the lower end of the chart. So that's a good sign for valuing the stock using price to earnings. And then we jump in and look at enterprise value to EBITDA. This time I included the table so you could see both what price to earnings is and what enterprise value to EBITDA is looking like. Well, we can see that enterprise value to EBITDA looks undervalued we're using the 5-year average and the 10-year average, not quite so on the 20-year average. So again, Valero, if we're curious, pays a decent dividend. They got a dividend yield of about 3%, which is a little over $4 per share, but their dividend is fairly reliable. So if we're interested in collecting a dividend and possibly buying a company that could be undervalued as well, this could be an interesting one to consider. Okay, now let's jump over and look at one of the larger companies in the industry. And this is an integrated oil and gas company. They do a whole bunch of things. This is Chevron. Chevron, again, is one of the bigger ones, one of my favorite companies in the oil and gas sector. I don't own any, but to me, it has been a solid company. They're a well-managed company from the research that I've done way in the past. Should do a deep dive in this one soon. Let me know in the comments below if you think we should, which energy stocks you think we should do a deep dive on. But we can see the current price is about $150 per share. The fair value using discounted free cash flow is up above $250 per share. So this one looks like it could be undervalued using discounted free cash flow. When we jump over and look at price to earnings, well, price to earnings looks, 1 out of the 3 averages looks like it's a bit undervalued. So not quite as much of a screaming buy over there, but it's so undervalued with discounted cash flow. Again, I'd still be worth researching, if nothing else. And then when we jump over to enterprise value to EBITDA, well, here we could see that it's not really that undervalued. Now, discounted free cash flow is my favorite. The reason I included it here is that's my favorite valuation method. And it's close to fairly valued when considering price to earnings and slightly overvalued here. So perhaps we want this to pull back a bit more. But overall, these are some good companies that could be considered if we're looking to get access or looking to get our portfolio involved in the oil and gas space or even the utility space. Now, if you'd like to get access to this website, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.